This was passed in the final hours of the year 2020. In this episode, I'm going to address Section 7702, the changes that took place with the stimulus package that is thousands of pages long, and how do they affect life insurance. So my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist for more than 4.5 decades. And one of my favorite instruments to allow people to accumulate their serious cash, money earmarked for serious goals like retirement, totally tax-free, and be able to access that money tax-free during their golden years. And when they ultimately die, it blossoms and transfers tax-free, is a max-funded indexed universal life insurance policy. Why? Because it passes the liquidity, safety, and rate of return test with flying colors, and it's been a tax-free sacred cow in the Internal Revenue Code for over 107 years. Now, the merits of an insurance policy are that the money accumulates tax-free under Section 72E of the Internal Revenue Code. All the money you are earning, the interest, dividends, and so forth, is tax-free. Why? Because the government doesn't want to hurt you from accumulating money, taking ownership, to take pressure off of them having to take care of you with welfare or whatever in your golden years. So this is why people accumulate money tax-free for their retirement. And if you happen to die, Section 101A of the code says it will blossom and transfer tax-free as life insurance death benefit. That's tax-free. Why? Because they want to make sure that widows and orphans aren't draining on government welfare programs. So why would they want to tax something, take money away from people who were trying to leave behind something that would have sustained them and their family had they lived longer? So that's why it's been sort of a sacred cow. It's tax-free. Now, Section 7702 actually allows people to access money out of an insurance policy totally income tax-free while they're alive. And this is what I have used for years to be able to create tax-free income. So that every million of cash value in my universal life policy can generate $70, $80, $100,000 a year of tax-free income because I'm earning maybe 9 netting 8. Maybe some years I'm earning 11 netting 10. Some years maybe I'm earning only 6 netting 5. But I have averaged payouts of 8 to 10%. That's tax-free income. But in order to have tax-free income, you have to jump through what are called TEFRA, DEFRA, and TAMRA hoops. It means this. Back in the 1980s, 1982, 1984, you had to have a commensurate amount of insurance coming along for the ride so you don't exceed the definition of life insurance under those sections of the code. So if I want to reposition at age 60, let's say, $500,000 into an insurance policy, I have to have at least $1,250,000 of life insurance. Now, the objective is to have my $500,000 grow tax-free, maybe double to $1 million in as little as 7 to 10 years. Well, I can do that. And that money, as it grows, qualifies as part of the death benefit so that the cost of the insurance goes down as you get older because the amount of insurance at risk is getting less and less. This is what makes it such a tax-free cash cow for retirees. Now, Section 7702 also said under TAMRA, that was passed June 21st, 1988, that the fastest you could fund it is over 5 years if it's universal life, 7 years if it's whole life. It's called the 7-pay test. That's a misnomer with regarding to universal life. So that means if I want to put in $500,000, the most I can put in is $100,000 a year, every year for 5 years. Now I could put in $100,000 the first day of the first year, and by the 4th year and first day of the 5th year, I can put in my last $100,000. Now I'm qualified to have tax-free income forever after out of that contract. That's the TAMRA test. That's Section 7702. Well, that's been that way since 1988. Now, in March of the year 2020, the insurance industry started to introduce legislation to be able to allow people to put in money faster. And all of those rules passed back in the 1980s were based upon 4% interest guarantees. See, whole life insurance for years has been based upon they will guarantee you 4%, or at least the actuaries were based on that. And so they tout, well, this is guaranteed to be no less than 4%. Well, when U.S. Treasuries ended up being less than 1%, interest rates are low, that means insurance companies are hard-pressed to be able to guarantee 4%. So they introduced legislation, but it was tabled. In the wee hours, the final hours of 2020, they slipped that back into the economic stimulus package, and it got passed. So Section 7702 has been now altered. I don't know what the total ramifications are, but I can give you a few glimpses, and then subscribe to this channel, Three Dimensional Wealth. And as I get more information, you will get answers to those, because I'm going to post several videos in the next few months that will help you understand what this means for you. But in a nutshell, this is what it means. For whole life insurance, it appears that it means that whole life won't be able to tout the 4% guarantee anymore, that new policies will only be based on 2% guarantees. So whole life insurance is going to have to perform based upon dividends. It can't be touted as, oh, look at our guarantees, they're 4%, because it's going to be down to 2%. Now, universal life, we don't worry about the guarantees because you're linking to an index. In other words, the guarantee with indexing is zero. What? Zero? It means that if the market goes down, you will not lose. Zero is your hero. We're not worried about guarantees because in Index Universal Life, the objective is to have your cash value grow to be close to the death benefit as soon as possible, maybe 10 or 15 years. So the cost of insurance gets cheaper as you get older. You're self-insuring. Now, what does this mean? Based on that example, it appears as though instead of being restricted to $100,000 a year for 5 years, I may be able to put in maybe $130,000, $150,000. With the new Section 7702, I may be able to get in the $500,000 faster, maybe as soon as 2 years in one day instead of 4 years in one day. What does that mean? Well, it will likely mean that if you can get the money, the $500,000 in there faster, it will grow faster because universal life has often outperformed whole life because the fastest you could fund a whole life was 7 years. Universal life was 5 years, actually 4 years in one day. Now, if I can get the money in that I want to put in there in 2 years in one day, let's say, it's going to grow faster. If I want to achieve an internal rate of return within 1% of the gross rate of return, instead of maybe waiting 10 years or 15 years, that may happen in 8 years, maybe 7 years. So you'll be able to get a great internal rate of return quicker because it looks like you'll be able to put in the money faster. Or you may be able to reduce the death benefit in order to put in the amount of money you want so it performs better as a capital accumulation account. So whatever happens with Section 7702, stay tuned to this channel because I think in the long run, this is going to be better for you. You're going to get better internal rates of return. You'll be able to get away with less insurance. In other words, have less costs. Or for the same amount of insurance, you can fund it faster, put in more money or put in the money faster, which accelerates the performance. So at the end of the day, when the insurance companies adapt to this, I think it's going to be a positive. They have not done anything to alter Section 7702 since June 21st, 1988, and they just sneaked it in the final hours of the year 2020. So stay tuned. I'm here for you. I want to empower you, and I will post future episodes that will show you what this means for you, especially as you consider taking out new indexed universal life policies and how they can perform even better than they have in the past because they've been superior. Now, I think they're even going to get better. If you want to learn more, if you want to understand what I'm talking about, Tefra, Defrin, Tamar, Section 72E, 7702, and 101A, I want to gift you a copy of my most recent best-selling book, The Laser Fund. Claim your free copy. I'll pay for the book. You go to laserfund.com, L-A-S-E-R fund.com, and you contribute a nominal amount to cover the shipping and handling. If it's short, I will cover the rest of that expense. I will pay for the book and fire it out to you. And in this book, you will learn about all of these nuances of max funded index universal life, why I call it the laser fund, liquid assets safely earning returns. And as you learn these basics, then when I share new videos about how Section 7702 changes and enhances this, you're going to be well equipped to understand it instead of going, what's TEFRA, DEFRA, and TAMRA? You'll know when you study this book.